Hello, everyone. Welcome to Awaken Your Freedom Show. Please subscribe to support our growing community. All right, today we're diving into some really insightful stuff about building wealth. We're looking at ideas closely linked to Tony Robbins' book, The Holy Grail of Investing, based on material one of you shared. Thanks for that.
Yeah, and it's interesting because it's not just, dry finance, not at all. It really blends the hard investment strategies with like the psychology side of things. Achievement.
Do
It draws on interviews with giants, Paul Tudor Jones, Ray Dalio, but seen through that Robbins filter of peak potential.
Exactly. So our goal here in this deep dive is to pull out the really key nuggets from this source material, help you kind of sift through it, grasp the core concepts, and maybe see wealth building a bit differently.
Yeah, less about just chasing hot stocks, maybe more about building a solid, resilient system for yourself.
Okay, let's jump right in then.
Sounds good. So first, big principle that really stands out is this asymmetrical risk-reward idea.
Yes. This is the one that feels kind of counterintuitive, right?
Right.
The idea that, hey, you don't actually need to be right most of the time to win big.
Exactly. The core thought is pretty straightforward, but deep. It's like, don't risk a dollar unless you stand to make, say, $3 back, or 4, or 5, maybe even more. It's the complete opposite of gambling, really. You're actively looking for situations where the potential win is just way, way bigger than the potential loss.
And the material gives that great example, Paul Tudor Jones. It points out he's not legendary because he hits it right 80% of the time or something. No, he's successful because when he is right, the wins are massive.
Yeah.
And when he's wrong, he cuts those losses super small.
Right? It's all about managing the size of the outcome.
Not just how often you call it right.
Yeah. Which, interestingly, the source contrasts with traditional diversification. We're always told, diversify, diversify. But just buying lots of different things that all kind of move together, well, that can actually water down your best shots, dilute the potential.
So this asymmetrical approach is more about focusing your bets, where that risk-reward ratio is heavily stacked in your favor.
Precisely.
Okay, so here's a thought this sparks. Does this principle apply outside investing? Like, could you look at career moves this way? Or maybe starting a side project? Even relationships, focusing where the potential upside just blows the potential downside out of the water. It's a different frame.
Definitely a powerful filter for making choices.
Yeah.
And speaking of protecting yourself, that leads right into the next big idea, the all-weather portfolio, designing for resilience.
Right. This one draws heavily on Ray Dalio's work, as the source explains. And it's not just about owning different stuff. It's about owning things that are non-correlated.
Uh-huh. Things that don't move together, like stocks, maybe long-term bonds, commodities, gold. Assets that tend to react differently depending on what the economy is doing. Inflation, deflation, growth, recession.
And the source points to the COVID crash as a sort of real-world test case. How portfolios built on these all-weather ideas, designed to hold up no matter the conditions, offered real protection when a lot of standard stock-heavy portfolios just tanked.
Yeah, it highlights a key insight. True diversification isn't just owning 100 different tech stocks. Because if the whole tech sector drops or the whole market drops, you're still exposed.
So real diversification, in this view, means owning asset classes that kind of zig when others zag.
Exactly. Building something that can actually weather any economic storm, not just a mild shower.
Okay, it makes sense. Build a strong base.
But then you got to protect that base from something sneaky, fees. That's principle 3. And the source material is pretty blunt about it.
Oh yeah, doesn't hold back.
Yeah.
It talks about hidden mutual fund fees, advisor commissions, describing them as silently, slowly bleeding your wealth away. Like a vampire movie in slow motion was the phrase, I think.
Huh. Yeah, something like that. And the math is just brutal when you look at it. The example given, just the difference between paying, say, 1% a year in fees versus 3%. Over decades, that compounds into potentially millions of dollars you just never see. It's gone.
It really puts the work of someone like Jack Bogle into perspective, doesn't it? Founding Vanguard, pushing for those low-cost index funds, it was revolutionary precisely because it tackled this fee problem head-on.
Absolutely. He helped average folks keep way more of their own money. And the source gives this real-world wake-up call example. Imagine you earn a decent 6% return. Okay, not bad. But if you're paying 2% in fees...
Wow, you've lost a third of your gain right there, before you even account for taxes or anything else.
Exactly. And that happens year after year, that constant drag. The source calls it heartbreak over the long run, and you can see why.
It makes you think, what if we viewed fees less like just a financial cost and more like I don't know, like distractions,
Right.
or like things that just drain your energy, things that slowly eat away at your time or focus without you realizing the huge cumulative impact.
That's a really interesting way to frame it. A powerful analogy. Okay, so moving from mechanics, the numbers, the fees. Principle 4 gets into the mindset, the psychology of wealth.
Yeah, and this feels very much like classic Tony Robbins territory. The message from the source is clear. Wealth isn't just the number, it's a feeling.
Mm-hmm. A feeling of freedom, of control, of having options, possibility.
Right. And the source uses those powerful contrasting stories. The billionaire who's completely miserable and stressed versus maybe a middle-class couple. They aren't super rich, but their passive income covers their needs and they feel peaceful, abundant, free.
Yeah, that contrast really lands. They have what matters. And the source connects this to Robbins' work with other high performers, Navy SEALs, elite athletes, CEOs. It emphasizes that the inner game, the mindset, is always crucial for top results. Finance is no different.
It's never just about the strategy.
Never. So the kind of fresh insight here is maybe the question we should ask isn't just how much money do I need? Maybe start with what kind of life do I really want? And then, okay, how much financial freedom does that life require?
That flips the script. It puts the life first, and money becomes the tool to build it.
Exactly. Money serves the life, not the other way around.
Which leads perfectly into the last big principle, compound interest and the game of time.
Ah, the magic of compounding. It's an old concept, but the source really hammers home its power. Starting early, being consistent, even with small amounts. It's just astonishing what happens over decades. It's literally how ordinary people can become millionaires. No genius required, just discipline and time.
And they use that amazing story of Ronald Reed.
Oh yeah, the janitor.
The janitor and gas station attendant from Vermont. Lived simply, saved consistently, invested in good companies for ages, and quietly built up an $8 million fortune. Not through some secret trick, just compounding in time.
Incredible story. It really illustrates the point. And the source quotes Robbins making a pretty bold claim. The most powerful wealth-building force isn't how much you earn. It's compound growth plus a long runway. Time.
Your money becomes like an employee that just works for you 24/7, never sleeps, never complains.
That's the goal. Get your money working hard for you early on. Or the alternative is you risk working hard for money your whole life. The choice is stark when you put it that way.
Okay, so let's tie this all together for everyone listening. What this source material, inspired by Robbins, seems to stress is, look, it's not magic. There's no get-rich-quick button. It's about discipline, understanding these core principles, and building a system.
Right. Where the psychology meets the financial strategy. Where your emotions help you execute the plan instead of derailing it.
Yeah, it encourages you, the listener, to maybe stop chasing the latest hot tip or trying to perfectly time the market ups and downs.
And instead, focus on designing a financial life that's resilient, where money is a tool you control, giving you freedom.
Not something that controls you through stress and fear.
Yeah, trading that fear for clarity, trading the hype for a solid system. And ultimately, the source suggests the real holy grail. It isn't just stacking up cash. It's the freedom that cash can provide, the freedom to live your life truly on your own terms.
A powerful distinction.
So maybe a final thought to leave you with, building on all this, what if really rethinking your relationship with risk, understanding the true cost of fees, and maybe even redefining what wealth actually means to you? What if that fundamentally changes how you approach your entire financial future, and maybe even your sense of personal freedom right now?
Something definitely worth considering. To close, please don't forget to subscribe on your favorite platform, YouTube, Apple Podcasts, Amazon Music, or Spotify to stay sharp and never miss a drop of knowledge that could change your financial life. Thank you.